think we all recognize it's George Soros, a very famous investor. Obviously started his career in the UK and then went on to the States, worked in London as an arbitrage dealer for a while, and essentially failed as a philosopher. That's really where his initial passion was, and decided to get back into the game of investing money. And so he started the First Eagle Fund, which later became the Quantum Fund in 1969 with Jim Rogers. So we've just got a few key highlights, I guess, of an incredible career. Soros is the same age as Warren Buffett. Most famous, George Soros, for breaking the Bank of England. Bronwyn, I don't know if you've ever come across that.
How much did he make from breaking the Bank of England?
That came with a profit of $1 billion at the time, Bronwyn. So
a nice tidy profit there.
Certainly worth his while. That was something he did with another famous investor, his protege, so to speak, who was Stanley Druckenmiller. But he's also been very synonymous with momentum investing and buying stocks almost on a trader's whim and holding them for very short periods. He then extended that into currencies, bonds, and as we've mentioned, in 1990 broke the Bank of England. But George Soros, incredible philanthropist. I think at the moment he's probably number 12 or 13 in the Forbes richest list of Americans, with a wealth of $18 billion. And he's probably given about $10 billion away already through various initiatives. He's got this open society which he drives, where he tries to fund countries that are emerging from very, not quite fascist, but very strict and conformist regimes. And he's done a lot of work in South Africa. But I think let's get to the key concept of George Soros and investing, and it's quite an abstract one. As I mentioned, he was a failed philosopher, what he calls a failed philosopher, and he came up with the concept of reflexivity. And essentially what that means is that investors are all biased because as an investor, there's only so much information you can absorb, and you have natural biases. Your personality gives you a bias into sort of analyzing data in different ways. So I think what we can do, Brian, is just have a look at what I think is probably the most easiest way of understanding reflexivity, and that's something you can do in the credit markets. And what I've done is I've drawn a very nice little neighborhood here. I think we're going to bring that up onto the screen just now. It's called reflexivity in credit. And essentially what happens is when you lend money to people, the act of lending money to people actually creates the value or can increase the value of that asset. And essentially,
so it's relatively simple is what you're saying.
In principle, it's relatively simple. So if we think about the South African property market at the moment there's not a lot of bank lending going on. We've seen very low credit growth from the banks. And essentially, as the banks start to lend, that money comes into the system and the value of the property rises. And that creates a positive feedback, because as the property values rise, the banks look at their collateral and they say, well, the house prices that we've lent against have gone up, so we can lend some more. And that obviously lends itself to more credit. And as the credit continues, you can get into bubble territory. And ultimately, at some point, things have to correct. And I think we saw a little bit of that in 2007, 2008.
Do we see lots of fund managers using this philosophy?
Well,
the concept of reflexivity.
To an extent, I think that not so much reflexivity, but they use what you call the momentum investing, where you try and invest in securities or shares that are going up. And essentially, I've identified two in our local market that kind of follow the momentum investing approach. One of them is Gail Daniel at the Investec Managed Fund, and the other one is actually a passive ETF. ABSA came to market with the Momentum ETF a while ago. But I thought as Fund of the Week, with a similar sort of approach, we could use Gail Daniel's Investec Managed Fund, and I've just brought up a few of the common, I guess, features, if you can call it, of that managed fund.
Then we obviously need to get Gail Daniel onto the show. So this is actually a call to action. Gail, if you're listening, we'd love to chat to you soon on Investment 360.
We have tried, and Gail says she's got she prefers doing radio, so we'll try her on the television story.
We'll keep working on it, Warren.
But to give you an example of momentum, it means buying positive earning revisions and sell negative earning revisions. So like we're going to have, we have value managers on the show that look for prices that are going down. Gail and her team at Investec will actually look for prices that are going up. And she calls that's obviously momentum. And the way she kind of phrased it to me the last time I spoke to her, it's kind of like buying the shark as opposed to the whale. And what that means is if you have a company that's
buying the shark as opposed to
the whale.
The whale. I see.
So it's essentially buying companies that have a lot of operating and earnings momentum. And so if we look at our food market at the moment, one of the examples she cited is that Woolworths is able to win market share from the likes of Pick and Pay and perhaps Spar to a lesser degree. So she's been buying Woolworths, and Woolworths has had earnings momentum. There's lots of positive earnings revisions coming through, and that would be an example of what a momentum trade would be like. So we do have some performance of the managed fund.
So we need to move our slides there.
We'll get to at the moment. But at this point, I think just looking at a top 10 holdings.
There we go, Warren. Rolling 12-month returns.
Rolling 12-month returns. This is obviously going through the financial crisis. And then you can see it is a balanced fund. So the returns you're getting, first of all, have been pretty consistent since the global financial crisis. And you can see probably not too much detail here on the chart, but here's 10% per annum return. These are 12-month rolling returns, 15% and 20%. So if you look at the return profile of the fund, it's been pretty consistent. And that's obviously a very good feature for investors who don't want to lose capital, but also a key feature of a balanced fund.
Can we go into the top 10 holdings? I'm always interested to see what stocks these asset managers are holding with their different styles.
Got them up at the moment. So British American Tobacco, I think everyone who's involved in the markets has just been seeing how that company has been buying its own shares and delivering earnings growth every year. And then we've got obviously Sasol, SAB Miller. It's another industrial company that's had a fantastic run.
Aspen, no surprise to see Aspen there, nor Naspers, considering the current discussions around both of those stocks. Obviously, the slight pullback that we've seen as a result of Tencent on Naspers, but it doesn't look as though it's going to stand in the way of the longer-term momentum.
Absolutely. These are, I guess, what we'd say is companies all at the top of their game. So value managers would avoid these like the plague, but momentum managers would love these companies. Quite interesting to see Lonmin in there. Obviously didn't get the chance to ask Gail why Lonmin's in there. And perhaps maybe we might see the likes of Coronation coming into that in due course. Woolworths is actually not there anymore, as you can see. So perhaps Gail's taken some profits and banked those.
Oh, Warren, thanks so much for those insights. Well, that's it for Investment 360 this evening. Thanks, as always, to my co-host, Warren Dick. If you'd like to send us feedback or suggest topics to discuss, contact Warren on @Warren_Dick. You can also follow me on @Bronwyn Nielsen. After the break, stay tuned for Hot Stocks, where we focus on the telecommunications sector.